Hi everybody, Ted Greene with Spartan Investment Group. Here we are the first week of May in Seattle, Washington. We're glad you're here online and those in person here in the office. This is our monthly meetup. Let me just outline a couple of things that we like to do on our meetup. And by the way, this is being recorded, so if you hear anything on the live event, but we move past it, you can always come back to it in the recorded version. Contact information is behind me. Let me tease for just a moment what we're doing next month. In light of all of the drama that's been happening in the banking industry, in the REIT space, in lending in general, next month in June, we're having Alex Peters, who is the Chief Investment Officer of Hoheimer Wealth Management. The interesting background for Alex is that he used to be a Wall Street REIT analyst. He's a CFA. For those of you who know in the market, a CFA it's really hard to get that designation. Hoheimer Wealth Management runs $1.2 billion, and they allocate heavily to the alternative space. So if you're interested in hearing an institutional approach to the alternative space, drop in next month. I'm looking forward to that in a big way. This month, we're going to be talking with Michael on tax credits. Michael, take just a moment and give us a little bit of background on yourself, and then I'm going to advance and I'll take control back for another minute, but give us just 3 sentences on yourself.
Sure. So I am a tax attorney. I live and am licensed in California, but I work with organizations all over the country to bring them tax credits for their businesses, and also we do tax planning for intergenerational wealth transfers, and to be as tax efficient as possible for legacy planning.
And tax credits neutralize or offset tax problems, right?
That's right. So what I tell people is that tax credits can manage or mitigate your tax issues today, and then planning can mitigate your tax issues tomorrow.
We are all in the right spot. So I'm gonna deviate, and then we're going to come back to you. So in the world of investments, Spartan has, from the spectrum of conservative to aggressive, Spartan has 3 opportunities this year. One is a debt fund paying 8 or 9%, depending on share class, and that pays monthly to the investor. We have an income fund, which is a low-risk equity model, and we have our growth fund for 2023, which is a octane booster, high-risk model, potential for high returns. Those are equity investments that come with bonus depreciation for equity investors. And if you have interest in any of these opportunities, contact information on the screen. By the way, one thing that I find is very interesting is the dilemma of tracking a portfolio of private investments. And so on the screen is my LinkedIn profile, my name, obviously Ted Greene, E on the end, Spartan Investment Group. I did a post on May 5th where you can find that post on LinkedIn, and you can download the tracking tool. Feel free to connect with me if you have questions. And so, Michael, back to you with regard to, let's flesh out a little bit about your practice from a 10,000 foot level, top of the funnel. What's the typical profile, and how do you help that typical profile investor, or are individual retail investors not your target market? Do you work with institutions? So just swim around in that big question. Yep.
So we work with business owners and investors, so either actively managed businesses, or a lot of times people who have either inherited wealth or they have exited a business successfully that now make individual investments on their own behalf. So family offices, those kind of things. We work in 2 primary spaces, in the tax for the business owners that we work with, and also the real estate clients that we have. A lot of the real estate investors that we have, we identify and then help clients obtain ongoing tax credits so that they can lower their tax bill in a legal way. Sorry, it sounded like I said illegal. It said unlegal way, a legal way. In a very legal way,
Yep.
On a now basis, and then we help families plan for their future through either estate tax planning or things like that, which is a hot button item for people now,
Right.
given the sunset provisions of the Tax Cuts and Jobs Act
Yeah.
that are going to be happening at the end of 2025.
So there's a lot there in that 2025. So let's come back to that in a moment. Imagine, for example, somebody who's going to sell a piece of real estate. The last 12 years, the last 12 years, very low interest rate environment. So asset pricing is I would say rich. Or maybe have a large stock position that a retiree is maybe thinking of liquidating, Microsoft, Amazon, what have you. So is that the type of investor that could approach you?
Sure.
And then what does it look like as the investor comes through the process with you? What actually happens and what?
Sure.
Yeah.
This is a good question. So these are probably two themes that we'll come back to frequently during this topic. The first is that there's no solutions, there's trade-offs. So there are things that you can do to really save a lot of money in taxes, but there's always pros and cons.
Yeah.
Right? There's no free lunches in tax, right? The second one is that everything is bespoke. So even the examples that you provided, there are probably 3 or 4 options that someone in those positions can, strategies they can take on, depending on what their actual desired goals are, both short-term and long-term. Maybe they think that they want to just pay as little tax as possible, but that's to the detriment of something that they want to do 3, 4, 5 years down the road, right? So the part of this is what I say is it's all got to be bespoke. It all has to be whatever planning options there are, and there are many. It has to be the right solution for the particular facts and circumstances of each client.
So flesh that out a little bit more.
Sure.
I'm still not like if somebody's going to sell $1 million of Microsoft stock.
Sure.
What would happen?
So typically, when you have it's a long-term gain, right?
Yep.
If you're holding it for at least a year and a day, you're going to be subject to capital gains. So where I live in California, there's no provision for capital gains taxes. Capital gains are taxed at ordinary income rates. So you're paying at the top end to about 13%.
Okay. Yep.
Just in California, and then you're going to pay 20% to the federal government. Again, if it's graduated, but likely if you're in that income bracket. So you're talking about a third of your profit is going to go towards either the federal or state government in that particular area. There are offsetting mechanisms. There are currently if you wanted to invest that capital gain into what's called an opportunity zone investment, you can do so and defer taxes until 2026, and then whatever. So basically, an opportunity zone. Do you want to dive in on that topic real quick? Or
I want to get there eventually.
Sure.
Let's if the investor is not inclined to go to an opportunity
Sure.
zone and is still dealing with $1 million of gains.
Yeah. There's other things that you can do from a planning perspective in terms of, and it kind of depends. This is why it's very bespoke, right? If you have family members, there's gifting opportunities that you can do. I think gifting is one of the more underutilized mechanisms to transfer wealth to different generations. So each individual, for example, in any particular period of time can gift another. The current rate is $17,000. So I could gift you, no questions asked. Not that I'm going to do this right now, but I could, if I wanted to, gift you $17,000, no questions asked. So each individual can do that. If you're a married couple with a child, you can gift that child $34,000 as of this year. No questions asked. No implications from a gift tax perspective. You can also transfer gift property, so you can gift some of those Microsoft shares to your children who are likely in a lower tax bracket than you are. So that's a possibility that you could do that.
Could I interrupt you?
Go right ahead.
On that note,
Yeah.
the unified credit it seems like when I was in my mid-20s, the unified credit was something like 600 or 650,000, and now it's up to 11 million, or
Yes. So it's, well, 12.9 right now.
okay. So by way of gifting, if an investor wanted to gift units of ownership of an LLC or some kind of entity, they can gift and do so by way of gifting part of their unified credit. So
They can.
Yeah, okay.
Which is actually a topic that we should probably touch on as well.
Okay.
So taking a step back,
Yep.
every person when they die, so most of the people, so when somebody dies, if your estate, if the things that you own is over a certain threshold, that estate becomes subject to estate tax. Not every state has an estate tax, many do. The federal government has an estate tax, and it's a very high rate of tax that you pay on assets, the value of assets that are over and above a certain threshold. Previously, that was a relatively low threshold, $1 million or lower. Now, because of some tax law changes, that threshold has increased to almost $13 million per individual. That increase is sunsetting.
There it is.
Yes.
Yeah, there it is. Okay.
So that increase is sunsetting at the end of 2025, and it's going to revert back down to still a relatively high level of $6 million, but on an individual basis. But that's a more than half cut.
Yeah.
So I think that is where we're starting to see a lot more interest from clients, is how do we mitigate, especially for those who have a lot of appreciated properties.
Yep.
Maybe they've held Microsoft stock since the 80s, or maybe they have a real estate investment that they've held for a lot of time in an era of low interest rates. A lot of that is appreciating property. How do they mitigate those taxes and ensure that their children and their children's children can reap the benefits of those things?
Yeah. And one more rabbit trail here. Frequently when talking to investors who have an IRA account that they want to convert to a Roth IRA account, and just actually I had this conversation earlier this week. The investor was, I want to move 150,000 from an IRA to a Roth. Well, okay, one thing you may consider, and consult your tax advisor, but make the investment in the IRA account. And because it's illiquid and non-saleable, non-marketable, the valuation discount will take that 150,000 down to maybe 120,000. So you're paying tax on 120,000 conversion as opposed to 150,000, and then that moves to the Roth. Is there a similar discount that can be taken on a gift in this whole topic?
You're going to have more challenges with your Microsoft stock question, or that hypothetical. But for illiquid assets, so like business valuations, so if you wanted to gift shares of your business, or you wanted to gift shares of real estate interests, or things that are illiquid, typically the IRS will allow a reasonable discount of the fair market value. So let's say you own a piece of property, it was worth $1 million, and you gifted it. You can generally somewhere between 30 and 40% of a discount in terms of the valuation of that property. And again, it has to be reasonable, but it can result in some significant tax savings and allow you to actually gift potentially more than that lifetime exemption to your whoever you want.
Yeah. Okay, so I really got us off track. If I can kind of replay.
My life is getting off. It's all about getting off track with clients and getting us back on track. So
well, and that kind of uncovers the need, actually. So anyway, so getting back on track. So we were talking about the Opportunity Zone fund, and then we started talking about the $1 million investor who has $1 million and would like to minimize the taxation on that. So specifically, what does it look like when somebody wants to sell an asset? They trigger $1 million gain, and then what do tax credits do? How do they use tax credits to make their life better?
So it's always helpful if there's an available tax credit, right? So there's a variety of tax credits that we work with, specifically around with business owners. There's research and development credits. There's a lot of different credits that we work with. If you're not in that business operation, entrepreneur type, if that's not your background, and it's more of a, maybe you're in a real estate investor, there are specific tax credits that are available to you, specifically around like the recent Inflation Reduction Act or things like that. There are opportunities to leverage recent legislation to obtain tax credits that can offset your capital gain. Now again, like those capital gain dollars are, when they're coming to you on an individual basis, they're going to be reflected on your individual tax return. And someone in that position who's selling Microsoft stock with $1 million gain, if they live in California, they're paying a $330,000 tax bill. So it's a massive chunk of their potential gain. You want to try to mitigate that as much as possible, so that either you roll that into another investment so you can defer that gain, or you take one of these other pathways, either through gifting or trying to identify and then obtain a tax credit to offset whatever the gain that you're looking at.
So a lot of most of the investors that Spartan works with are dealing with, they're the passive side. They're a passive investor in working with a syndicated security, and those investors don't just deal with Spartan. They're multifamily, industrial, workforce housing, what have you. Is there different tax credits for different kinds of passive investors? And I don't even know how to flesh that question out better than that.
So I think there's different tax strategies in general for different kinds of investors. So I'm sure all of your investors are familiar with like 1031 exchanges, those kinds of like-kind exchanges, which the rules actually tightened up for those like-kind exchanges to reduce the availability of those about 6 years ago, which is unfortunate, but they're still great for real estate investments. So, for example, I believe like Spartan is starting a DST fund, a Delaware Statutory Trust Fund. So if I'm selling a multifamily apartment building, instead of going through the process of a 1031 exchange on my own, DST is a Delaware Statutory Trust, is a vehicle that is similar in nature to the tax deferral mechanism. I can then roll my capital gain into a DST fund and obtain the same tax benefits as the 1031, but I am just now less involved. You have an institutional investment group that is managing the property or managing the investment. You get all the tax benefits of the 1031 exchange, but it's even more passive position in doing so. So when you have those kinds of gains, those are some of the options.
And I want to come back to the question before, but we're on the DST, so let me just kind of sharpen this for folks that work with Spartan. So our asset in Corsicana, Mini West, that $15-17 million property is likely going to feed our DST fund. High single-digit cash on cash is what we're anticipating. We need to sharpen that. Don't hold me to that. And so for investors who are looking for a home for a 1031 exchange, we're excited to reach out to you. Now, with that being said, let's go back to, so there's investors that are, commodity investors on the passive side, a whole host of passive investments that are here in the room and listening to this. So do all of those passive investments have the same kind of tax consequence, so that working with your firm, how complex is it? Apples to apples? Is it bananas, oranges, pears, cucumbers? You see where I'm going. Flesh it out a little bit.
It's the entire spectrum of the supermarket.
Okay.
The produce section.
You went up to me on it. Okay.
No, I like analogies and metaphors, so I like that one. It's good. It really depends.
Okay.
We do tax planning and tax credits. The IRS, the abundance of tax credits, and these are not just federal tax credits, these are even at the state and local level, like the city of Seattle, the state of Washington, they also offer specific tax credits that are available to specific types of taxpayers. kind of broadly speaking, the way that I try to explain the tax code to people is that it's a set of incentives, right? So like the IRS wants you to get married, so like society does, and so they give you an incentive, they give you a tax break for being married and filing a joint return. The federal government wants you to own a house, so they allow you to write off a significant portion of your mortgage interest and part of your property taxes. So it's a set. When you think about tax credits or tax planning, you've got to think about what is the incentive that either the government or society is trying to promote here,
Okay.
right? And then if there is something that is trying to be promoted, there's likely a tax credit around it, or there's likely a tax planning mechanism around it. You know, like in a certain way, the government wants you to be able to leave certain amounts of money to your heirs. They just don't want you to leave too much, right? So that they cap what you can leave without any kind of tax planning. However, if you plan for your estate in an intelligent way, you can mitigate your tax exposure or leave more to your heirs than you otherwise would have without any kind of proper planning. So that's not necessarily a direct answer to your question, but it's more of like when you're looking, it's hard to answer specific questions about specific situations because there's so much that goes into the discovery process with each client to make sure that whatever solution you are providing is going to make sense now, but also 5 years from now and also 10 years from now.
Yeah. Is there a way to and this is the question that you didn't want to hear, could be, and nobody's going to hold you to it.
I want to hear all the questions.
but back to this $1 million gain.
Yeah.
So what does a tax credit cost? And if we compare it to the 36 point, I think in the state of Washington, our max 36.5 or whatever the ordinary income ceiling is. But is there an apple to apple comparison?
Yeah, I think on that particular example, it's going to be more challenging to find a credit that's going to be able to offset. There are credits you can potentially purchase. We don't really get into that. Okay. Our firm does not necessarily do that kind of work because there's a little bit of a gray area. Okay. But in terms of that, instead of a tax credit opportunity, that feels, if a client walked in with that issue, I'd say this is a tax planning opportunity rather than a tax credit opportunity. And that's the thing is every situation that comes up with our clients, is there an opportunity to defer the tax or mitigate the tax now, or is there a way to do it? Obviously, like in this situation, I would have loved if the client walked in the door and said, I'm thinking about selling $1 million of Microsoft shares. What should I do? There's the ounce of prevention that you apply is from a tax perspective is almost always going to be better than the pound of cure that you would have to apply to mitigate those things in the future. So I think from a planning perspective, what could be done there in that example is that if that client had come into the office a month earlier, there are planning mechanisms to mitigate that tax exposure.
So as little as a month makes a big difference.
I should have said a year.
Sure.
It's like I'm making a little bit of a joke there, but the more I've had clients come into my office and say, I'm selling my business or I'm selling this piece of property, and I want to do it in a tax efficient way. And I said, great, when's it selling? And they said, 3 o'clock today. And it's like, well, we can't do anything. If you had talked to me a month, that's better. 6 months, that's even better. A year before, that's ideal. So planning, the further you can plan into the future, the better. And look, that's not always possible, but the further you can plan in the future, the more time you have available to plan, the better your outcomes are going to be.
So navigating forward, as we look at the primary concerns that investors have, I would guess that one of the primary concerns is how do I pay the least amount in tax that I possibly can and not go to jail?
Exactly.
I think we can all find common ground there. What are other concerns that your investors, that your clients have?
Yeah, I mean, you hit obviously the nail on the head. How do I mitigate my taxes now? Because we are, so there is a concept called the silver tsunami that we are seeing now. So the silver tsunami is essentially baby boomers that are selling a lot of their either businesses or their assets to become more liquid or things like that. They're essentially they're exiting out of the businesses they own and more into a passive investment environment. So that changes the dynamic of what they're concerned about, because they are less focused on the here and now and more focused on the how do we be tax efficient for the next 10 years, and then when I die, how do we transfer assets to the next generation in a tax efficient way. So we're seeing a lot of clients. I think that's probably from a tax perspective. Obviously they have other concerns about inflationary pressures and macroeconomic things, but from a tax perspective, how do we mitigate taxes and how do we transfer as much to the next generation as possible?
So, and then what does that conversation look like as you're, let's level up a little bit here. Let's say this is a $5 to $10 million investor.
Sure.
And they're having a liquidity event of some kind.
Yeah.
What does that conversation look like? And by the way, surprisingly, that's not me, truth be told. So okay, now you have to come back later with a better one than the dad joke I told originally. Anyway, so what does that conversation look like?
It's a good question. So and again, the conversation is going to be different if it's a $5 to $10 million as opposed to a 50 to 100 or a 500 to a billion,
Mm-hmm.
right? So that conversation is twofold. We really look at how much for the client themselves at that opportunity. We look at how much money do you need to live on. What do you want to have all the liquidity now? Because again, going back to the original theme, right? There's no solutions, there's just trade-offs. So there are some clients that I have talked to that walk in the door and we have a 2-hour conversation about what they want. At the end of the day, they don't want to do any tax planning. They want whatever their exit looks like, whether that's real estate or a business, they want all the cash right now. They want to be as liquid as possible. Mm-hmm. Others, they want to do some sort of trust planning so that they are mitigating their taxes now. They restrict their liquidity or their access to the money. They obtain it, they receive it over a period of time, either a fixed period of time or a variable period of time. And they want to generate a consistent income stream over a period of time. So there's a dozen ways that client, when they come into the office, they could leave with a dozen different concepts. It really depends on the conversation that occurs with the client, with sometimes their spouse, oftentimes their children. Because again, it's not just setting up that client for the success in the near future, it's about setting up their family for success in the long term.
That triggered something in my mind. Let's say an investor wants to fund a charitable remainder trust that then spills into the family foundation.
Sure.
As things trend. Is that your bailiwick? Do you help in that?
Mm-hmm.
Okay, so you folks really do the full Monty planning perspective.
Absolutely.
Okay.
Yeah, and I think that the one you just mentioned is a fantastic tool. Even what I tell people is that in a charitable remainder trust, the charitable notions, while they are great, it's not. I think some of the clients, they shy away from that because they think that they are just giving a lot of money to charity, but it's a mechanism for you to put an asset into a trust, obtain an income stream for an extended period of time, and then the residual will eventually go to a charity of your choice or your family foundation.
Yeah.
It's slightly less tax efficient with the donation to your family foundation, but you still would retain some additional control that you would not otherwise have.
Yeah. So moving to the next question. What tax opportunities are most investors missing that you shine a flashlight on and help them see?
Yeah, so again, everything is bespoke. So it's when a client comes in the door, we want to learn about if they own a business, what the business does, if they are a passive investor, what they're investing in. There's always something there. Right, there's always something that has been overlooked. I have not yet met a client where I'm like, no, you're all set. Like there's nothing available to you, right? So there's a couple things that I think are really important to both active business owners and passive investors that a lot of them miss. is asset protection. A lot of and this is a non-tax issue, but a lot of the clients that we talk to, we identify non-tax issues as well. So before starting this firm, I was a CFO of a large global management travel company, travel management company, I should say. And so I oftentimes look at a client's portfolio from that kind of viewpoint. Like we're hyper-technical tax people, but also taking a holistic approach. So a lot of times they don't have proper insurance coverage, they don't have an umbrella, they don't have the right entity structuring, they don't have their trust named on any insurance policies. There's a lot of things that asset protection it's always interesting to me that someone is able to accumulate such a wonderful amount of assets, but then they leave them unprotected and vulnerable to a variety of potential bad outcomes. A slip and fall in their house could put a lot of their assets at risk if they're not protected properly. The second one, so asset protection today is number one, and then the second one is, again, efficiently transferring their wealth to the next generation. I think that sunset, I don't know if you want to talk about now, we can talk about later. This might be a good segue.
Yeah.
So the provision in the 2017 tax law, better known as the Tax Cuts and Jobs Act, sunsets that increase in lifetime exemption from where it's currently at, around $13 million, down to about $6 million. It's going to be adjusted for inflation, so those numbers are going to be not 100% accurate, but let's just say it's $6 million. For some people, that's a non-issue. But for the type of clients that we work a lot with, it is an issue.
Yep.
And so the question is, how do you mitigate that reduction? Because a $7 million reduction in estate tax, or like the lifetime exemption amount, and so that would be a $14 million reduction for a couple. That's a $6.5 million tax bill if you don't take advantage of that lifetime. If you're over the lifetime exemption when you pass away and you don't take advantage of it now, it's a potential massive tax bill, $6.5–7 million.
So if an ultra high net worth investor has either a concentrated position in one investment, be it public or private, and has family and wants to set up generational transfer, seemingly making a move before 2025 is like the slam dunk, no brainer. Like, you got to do this or you're dumb.
That's right.
Good. I left the door wide open. You could have come back on me there.
You did.
Okay.
Yes.
Yeah.
You must do this, or else you'll have a big tax bill.
You'll have
That's right.
Politically correct. Okay, very good.
But I think you're right. And there's things you can do. There is some time left to do these things. But one of the interesting quirks about the tax law is, let's say that I am a high net worth person, and I want to maximize my gifting, or that I want to maximize my lifetime exemption. There are things that I can do. So if I use up $11 million of that lifetime exemption, the IRS has clarified that instead of reverting to a $6 million lifetime exemption, you will now, your estate tax will be based on that $11 million that you used up. So you can basically bump up your lifetime exemption if you hopefully pass away after 2026.
Yep.
You will be able to take advantage of an additional $5 million of exemption if you do the proper planning today.
So there's no clawback. You get you can get. I mean, and that doesn't cost you anything to gift that away. To give away your exemption, it doesn't. It's not like somebody comes and collects money from you. You're just giving away the ability to give assets away, and you monetize something that is on paper.
Yeah. And
give that thing away, and then the ceiling comes down to 6.
Yeah, that's exactly right. And so this really works well with families when the intention is to leave. So Warren Buffett is famous for saying, "I want to leave my children enough money so that they can do anything, but not enough money where they can do nothing.
Yeah.
Right. So I think a lot of families with the ability to provide intergenerational wealth feel a very similar way.
Yeah.
But they want to do things in a very tax efficient manner. So if the intention is to leave your kids, some level of assets, and you are over that $6 million estate amount, this is the time, the next 2 years, 2.5 years is the time for you to really take advantage of those estate tax provisions before that sunset occurs. Because if you do it now, and especially, if it's an illiquid asset where you get a reduction of the actual valuation of that, you can really improve the amount that you're able to transfer in a tax efficient way.
Cool. Yep. I think there's enough there to kick the door open for the investor that's been thinking about gifting that should cause activity. What other strategies, mechanisms are not maybe on front of mind for many investors?
Sure. So again, going back to the asset protection provision, we have looked at some family limited partnerships. So basically, you're putting assets into a family partnership. You're able to retain control of the assets, and a lot of the income can go to your beneficiaries, whether it be your children, your grandchildren, your friends and family, whoever you want it really to be. It needs to be family members. But you can essentially protect your assets through that family. And this could be real estate, it could be investments, it could be a lot of things, and then you can either gift shares of that partnership. Most of the time, we see gifting of shares to the partnership to family members. And again, those kinds of things can help fund your beneficiaries or your heirs now, or for whatever time period you're looking to do so. So we're looking a lot of dynasty trust planning, a lot of some charitable giving through the charitable remainder unit trusts vehicles, and the family limited partnerships are also important.
So is there a tax triggered when let's just take my wife Melissa and I, and let's just imagine that we own a part of a business. If we were to transfer the ownership from our joint name into a family limited partnership, does that trigger a tax?
So a contribution to a partnership is not a taxable event. The distribution of shares into other beneficiaries will have estate tax ramifications, potentially, right? Like if you're under the exemption limit on an annual basis, so that's $17,000 a year we talked about, potentially no estate tax ramifications. So we're seeing that as well. If you contribute your ownership interest to a family limited partnership, that should not be a taxable event for you. And then you can potentially gift shares of that family limited partnership to heirs on an annual basis below that $17,000 threshold without tax implications.
If Melissa and I wanted to keep the income that comes from the investment and not distribute it equally to other owners of the FLP, could we do that?
I feel like this is starting to become a personal tax consultation.
You may or may not be right on that one.
Yes, you can do that as well. So you don't necessarily have to distribute I tell people, by the way, it's a stupid joke, but like when I do a lot of travel. I travel about 200 days a year to go visit with clients. It's a lot, especially when you're 6'10", fitting in airplanes.
Yeah.
Not so great. But when I have a conversation with my seatmate and I tell them I'm a tax attorney, they either immediately turn away because they think it's going to be a terrible conversation, or it's a 3-hour consultation. Yeah. So
and you're captive.
That's right, exactly. They have a captive audience. So in those kind of situations where if you are contributing the assets, you can retain control over that partnership and dictate what happens to the income of the assets within there. So one of the things that clients really enjoy about that particular vehicle is that you retain a lot of control around that. So if you did not want that income to always go to the beneficiaries, you can manage that. So again, this is why some people, everyone's different. So this is why it's all bespoke planning as well.
Yeah. And while we have a captive audience here, if mom and dad want to gift assets into a revocable trust, that's not a taxable event. Am I correct on that?
Correct.
Yeah. Okay. So yeah. So the genesis of this is schedule a paid tax consulting pay for a paid appointment.
That's right.
And do so in advance. Okay. Well, let's pivot to business owners.
Yeah.
So what strategies should a business owner be considering in light of tax credits, in light of 2026 or 2025? 25?
At the end of 25, beginning of 26.
Okay, yeah.
And again, it depends. There's different tax strategies that are available to business owners. Part of this also is, it always honestly comes down to level of risk. Again, as well, there's some strategies that are a little bit they're a little bit more fact intensive. They're a little riskier. So, like for example, for business owners and also potentially for passive investors, depending on what their portfolio looks like, captive insurance is both a very wonderful tax planning opportunity and an incredibly abused product, right? So basically, if you're captive, if you're a business owner and you're paying a lot of insurance, let's call it at least $500,000 a year, that is a sunk cost for you.
Mm-hmm.
Let's say you have really good, your insurance levels are high, but you don't have any losses, and you want to retain. You have the ability to essentially start your own insurance company, and then you'll pay premiums to the insurance company. And if you have claims, that insurance company will pay the claims, and then anything residual within that insurance company after a period of time can be distributed back to you. Sometimes as ordinary income, sometimes as capital gain income, so there's also some tax preferential treatment there. So that is captive. Again, it's a wonderful opportunity for businesses that can and should be doing that, but there's a lot of abuse. If you have $500,000 of insurance coverage and then you try to give $5 million to your captive insurance company every year as a tax shelter, the IRS is going to frown upon that. But there's mechanisms to do things like that to offset your tax liability and also grow your personal wealth. Other things we look at for clients, we look at, depending on the industry, there's credits. If you're in television production, there's film credits, there's research and development credits. And again, going back to why do these credits exist? It's because governments want to incentivize certain behaviors, right? So if manufacturing has left in large part the United States, a lot of states offer sales and use tax and property tax exemptions for companies that have manufacturing equipment that they buy, and that can be a massive tax savings for a lot of clients. And you don't necessarily have to be running a factory in order to obtain a manufacturing credit. You can be, as long as your whatever you're doing in your business can fit within the statutory language, you can obtain potentially a manufacturing credit, which can add up to tens of thousands, if not hundreds of thousands of dollars. Seattle is a big area for tech. A lot of companies can qualify for the research and development tax credit. And those tax credits are wonderful offsets to any liability you have. A lot of startups take advantage of them early on in their life cycle when they're not making money, and then if they do well, they can carry forward those tax credits to future years when they have large amounts of income.
And can the employees of those companies benefit from the credits that are given to the employer, or what's the waterfall look like?
They'll typically benefit from the employer having additional cash flow. So there's no direct benefit, but the indirect benefit would be a lot of the employers. So like do a variety of tax credits, and it's very rare for me to see an entrepreneur or a business owner take whatever tax credit money and just put it in their pocket. They're usually using it to improve the business operations, improve the employee experience, improve something about the business. It's just the way entrepreneurs are wired, where they're typically using that money. And I mean, some are going to go buy a Ferrari, but most of them are going to reinvest in their business because that's their true passion and that's what they want to do. And they want to typically make the experience better for their employees.
Gotcha. Well, I'm thinking of it. If you're watching online and you have a question, go ahead and put it into the chat, and Roy or Josh will send me a message, and we'll get your question answered. Michael, let's move to the next question, which is, what strategies should business owners avoid with regard to their taxes?
There's a lot. There's a lot of. So the IRS releases what they call a dirty dozen list every year. So this is. Let's talk about business owners and also passive investors. There's a lot of. The IRS considers a number of tax strategies to be invalid. If I'm being,
I don't like the sound
if
of
I'm
that.
being diplomatic, let's call it invalid. But there are people. And there's licensed CPAs, licensed attorneys, and that will promote these kinds of tax strategies, and they are very, very, very aggressive. Now, with that said, the IRS considers one of the positions I just talked about, captive insurance, to be that's actually on their dirty dozen list, and it's because those are kind of the strategies that are subject to abuse. So what I tell clients who are exploring a more aggressive strategy, the strategies can be great, but they will likely come with additional levels of scrutiny.
Yeah.
And you have to understand that it's possible that these things may not end up working.
What's an example? That sounds pretty juicy.
So. Juicy and taxes, those are two words are typically not in the same sentence, but they can be. We're seeing a lot of issues around conservation easements. So this is more for your real estate investors. So there's a provision in the tax code that allows you to donate your property to, basically they call it a conservation easement. So basically, thinking about this is, have a piece of property, it's generally undeveloped, and you agree to not develop it for a period of time. The IRS will give you a tax credit in order to just abstain from developing this. And the tax credit, so basically it's a charitable donation for the value of the land. People have gotten very aggressive in how they're valuing the land. So if you have a piece of property worth $100 and it's just vacant land, if you develop it, it's going to become more valuable. So they are taking. So a lot of taxpayers are taking the position that land should be valued instead of $100 at $1,000. And they are basically then they take that $1,000, they write it off as a charitable donation on their tax return, and that can result, depending on their tax bracket, in a $500 benefit. The IRS is not like that.
No.
So, and again, conservation easements can be valid, can be excellent tax planning tools, but they will likely subject you to additional scrutiny on your taxes. And some people just don't want that. Same thing with captive insurance. Especially if you are using the mechanism to turn ordinary income to capital gains income through the captive mechanism, the IRS is going to apply additional level of scrutiny. There are certain tax credits and tax planning mechanisms that they also frown upon. Like, there's a lot of our company, we do various tax credits. There's tax credits that are on the dirty dozen list, and when an entrepreneur, a business owner, sells their business, we're hearing a lot about these monetized installment sales that we do not do at our firm. Other firms will do them. So basically the concept is you try to spread the tax over
That
20.
sounds really good.
It sounds great.
Yeah.
And you know what they say about things that sound
Yeah.
too good to be true?
Yeah.
They generally are. So the IRS is applying, again, it's heightened scrutiny. And I'm usually not one to say no as a starting point if something, because every client is different. Every client has a different appetite for risk. But every client should be aware on the front end of whatever strategy that they are trying to implement, what the pros and cons are. And while there are strategies that can save you a lot of money, they potentially are also subject to a heightened level of IRS scrutiny, which some people just want to avoid that kind of level of scrutiny. Yeah. So anything that you read on the Dirty Dozen list, just be cautious.
Yeah. Okay, so Josh has sent me a handful of questions here. Let's pivot a little bit. So how does generation skipping trust work?
That is how much time you got?
Yeah, so we're back to the free consultation.
So I think that the question is asking about generational skipping tax more than anything else. And again, like all of these, everything we're talking about today, obviously, like based on your individual facts and circumstances, has to be discussed with your tax advisor. But there's no like 30-second answer to this. This is probably a question that's best answered in a 30-minute consultation.
Okay.
But it relates back to our estate tax conversation about to whom you can actually gift things and how much and when and what rules apply to grandchildren rather than children. And then depending on this usually applies in a multiple tiered trust environment, right? So like depending on what structure you actually choose is going to have an impact on generational skipping taxes.
So my understanding of a GST is, for example, my parents have, a lot of bucks. They put it into a GST. It doesn't hit Melissa and I tax return. We don't have control, but it's distributed to, for example, possibly Melissa and my children. So that's the general premise?
Generally, yeah.
Okay, and so then at some age or at a series of ages, the GST could release principal to my children. And if Melissa and I are in the Warren Buffett category where we've got enough to do whatever we want, why would we take it if my parents want to push it over a generation and it goes to my children? So, okay, so. And by the way, I really want to throw one. I keep thinking to mention this, and I want to take a minute to mention this. If you have parents who are elderly, one of the best techniques that I've seen to make life easy as they transition out of having control of their assets, whatever the financial institution that their assets are with, make sure you have a power of attorney from that institution, not just from the attorney. And the reason I say that is, if my parents have their assets at Wells Fargo or some institution, if I have a power of attorney that came from the attorney, the compliance department at Wells Fargo has to go read through this whole big long POA and figure out what can I do. Well, boy, I just botched that one up. What can I do on behalf of my parents? Whereas if you have a POA from the firm, boxes get checked automatically, and so the rep at the firm that you're talking to, they can see on the screen, oh yeah, Ted's approved to do this for his parents, so right away it gets done. So that's a big one.
It's a huge one. And two of my newer clients that did not do that are now going through that. It's a real challenge because it also, at those, especially the larger financial institutions, it takes forever. And a lot of times you don't have time, and so, and again, going back to our original conversation, the ounce of prevention in getting that form is much easier than the pound of cure that you have to apply after the fact. Because again, you have multiple lawyers looking at it at the financial institution, and it takes weeks, if not months, to get that done.
Especially on a stock trade. I mean, if you want to get something done and you have to wait, that's a hassle. Okay, so let's go to the next question here. We're starting to get close on time. So how can someone lock in the current 12.9 estate tax before it expires in 2025?
You can't lock in the full 12.9. You can get close. You can get to about, I think, 11.2.
Okay.
So, which is great. So if number one, if you have that problem, it's a great problem to have.
Yep.
Number two, you would have to do, so the IRS rules, I believe it was 2018 is when they came out with this guidance, is they said if you use up more let's call it $6 million for when that sunset occurs, if you exceed, so the example is I gift $10 million before 2026, but then I die, hopefully, after 2026, right? Am I using the amount of the gift, the exemption that I used, or am I using the $6 million? And the answer is, it's the greater of the two. So in this case, it would be $10 million, but not to exceed $11.2 million. So that's the answer. You can get all the way up to 11.2 if you are smart about using up that exemption now before December 31st, 2025.
Good question. Yeah,
it's a great question. I mean, that's honestly that's going to be, in the world of tax news, that's going to be the biggest story in the next 2.5 years.
No. Okay, what is a crummy trust?
A bad one?
Yeah.
It's a version of a charitable remainder trust.
Okay.
But it's again, these things are sometimes derivative of each other, but that's essentially what it is.
What's the upshot of a crummy?
It's the upshot of a crummy is that you are able to, from my perspective, and there's a couple different ones here, but I think the biggest one is that you're able to obtain a current year deduction for charitable purposes. You often see charitable trusts get implemented in the sale, during the sale of an asset or a business, because when that asset gets sold, because charities are not, or nonprofits are not subject to income tax, in most cases there's some exceptions, that asset does not get taxed. That portion of the asset that's placed in that any kind of charitable trust generally does not get taxed on the date of the sale.
No.
There are some exceptions, there's some S-corp implications, there's a lot of complexities around it, but typically that's the case. And so the primary benefit is that you also get a current, in addition to mitigating the tax in that initial year, and as the money comes out of the trust to give you that income stream that we talked about, over time you do pay tax on the distributions, but you mitigate the tax up front, and then you also get a current year charitable deduction on your current year taxes. And for most people, when they're selling that size of asset, it's the biggest tax year of their life.
Would a crummy trust or a charitable remainder, if I committed some horrific auto crash and did the most horrific damage to a lot of people and you went to litigation, is that asset exposed to a liability that I have personally?
Now I'm really hoping this is not a personal consultation.
Yeah.
So, but the answer is, the reason that trusts exist is asset protection. They're like the number one tool for that, and obviously the insurance piece that we talked about before. Those are the big two tools that you have in your toolbox for protecting your assets. So typically, there are mechanisms to pierce the trust in certain cases, but in the vast majority of cases, those assets do get protected within those trusts.
Okay, and here's one that for 30 years I've wondered. I've heard different answers to the question, and I'm wondering what your perspective is. Imagine there's a $10 million gift to a charitable remainder or to a crummy, and you don't hire a corporate trustee. It's the Ted and Melissa show, pushing on the levers and hitting the buttons, and we're managing the asset. From a litigation perspective, do we have risks that our beneficiaries might come back and say, you should have had a Hoheimer wealth manager trustee running that thing as opposed to the Ted and Melissa show, because Ted and Melissa, you're dumb and you didn't do the best thing for us, and now we missed out on gains, and so now we're ticked. The necessity of a corporate trustee is the real question there. What's the deal?
I think it is, you are mitigating your liability by hiring a corporate trustee or a professional fiduciary or professional trustee.
Yeah.
And again, this is it's one of those situations where if it looks too close, like this is your personal investment and you're specifically only doing it for tax avoidance, it could get voided, right? Like in terms of either by the IRS or by local court.
Oh, that's an interesting.
Yeah, because basically tax planning that is strictly appears to be for tax avoidance purposes is typically voidable. Not necessarily voidable, but it's possible. So I think that is the challenge in that example. If it's the Ted and Melissa show, then you're going to have a harder time justifying the purpose behind it.
So then, by hiring a professional trustee,
Yeah.
you minimize, you've removed that risk further. Not that it's gone away, but you've minimized the risk.
Not down to zero, but you are heavily mitigating that risk. Yeah.
Okay, that's really interesting. I hadn't heard that perspective before. That's a good observation.
You ask 100 attorneys for an opinion, you get 101. So.
Yeah. Okay, so if I'm gifting, next question, if I'm gifting ownership of my business to heirs today, is that irrevocable?
Whew. Depends. It really depends. It depends on the vehicle. You can do that through a couple different mechanisms. Typically a gift, just like this definitionally, a gift is something that you, for lack of a better term, like you transfer, I was going to say give, but you transfer to somebody with the expectation of getting nothing in return. So I don't think it's a true gift if it's not irrevocable. I mean, it's possible that person could gift you back their ownership interest in your company, but again, if you're doing this for tax purposes, that starts to look more like tax avoidance than to be a true tax planning mechanism. So there are ways, and again, going back to our concept of being an illiquid asset, closely held business is typically an illiquid asset, has the potential for reducing the amount of valuation of that business so that you can make a more tax efficient gift to your heirs.
Is a family limited partnership, is that one where that would be an irrevocable gift?
If you are gifting the shares in the limited partnerships, that would be an irrevocable issue, yeah.
Okay, we've got one more question. Are you able to help with international tax planning or support?
Wow, this is a really good question. We've done some internet. It depends on the country.
Okay.
And it depends on the question. So, it all depends. So the short answer is yes, but depends on the country. It depends on the question.
Okay. I'm going to go back on the. So now your contact information is up on the screen for CFO NW.com is where folks can find you. Any questions from anybody in the audience? Yes, sir, Sean.
I haven't heard you mention anything about life insurance, and I'm just curious. I feel like, especially on the high net worth side, most wealth planners have some sort of feeling about that, whether term or whole life, and how that can be utilized as a wealth transfer strategy too.
Sure. And let's just repeat the question. And the question was your general sense on infinity banking or universal variable or whole life policies for a wealth transfer mechanism.
Sure. I think life insurance is a great product. I'm partial to term because of costs, and I think it's more of a tax efficient mechanism. One thing I would suggest is in a life insurance, especially with a life insurance policy, if you are subject to the estate tax, you should probably be looking at an ILIT, so it's an irrevocable life insurance trust, because then you can, I hesitate to use the word avoid, because it's never a good idea to say you're avoiding taxes, but you're mitigating your taxes for estate tax purposes if you are either getting a new policy and putting that into the ILIT, or putting a legacy policy into the ILIT. So basically you are really mitigating your estate tax on those insurance policies. But I mean, again, life insurance I think is a great product in general.
I think that's it.
Some wonderful questions.
Yeah. Good. Well, Roy, why don't we cut the recording and we can wrap it up. And thank you everybody for sticking around and for joining us.
Yeah. Thanks everybody.